depending on how we react to that imbalance gap, something like this, we can take a trade, but we always have to wait for that reaction of that vector level. So it's a vector level because it creates those vector candles into our order block. But yeah, in this case, what happens is we react, then break that vector level. So we have a market structure shift. So now we got to look for an order block up on top of our vector level because we had that market structure shift. We know that this area, right, which is the area right above our accumulation inducement, is manipulation now because we broke our vector level, and all this is efficient price action. So I'll move that to here. All this is efficient now, and we have a little wick order block. As long as it's valid, it's valid.
So what is efficient? I was hearing you speaking.
Efficient. Okay, well, what I mean by efficient is really just imbalance. Okay, so we created imbalance here, so we created inefficiency. But what happened? We came and we filled that imbalance. Okay, so what happens when we fill an imbalance? We create efficiency in the market because it means that this point here mitigated to here. So we transferred here, telling us that we're moving that money up. We're moving the buying money up. As soon as we break the buying money level, because it's all moved up, there's no more money left at these points. So we just run them. So we run efficient price action when we break the first leg of it. Okay. And that's the idea with that vector level here. It's that last point of inefficient price action. We break it, we retest that manipulation, then we come back and run to the next mitigation cycle. In this case, there isn't a super clear order block, but we could have used this level here because there's some orders left at this point. But I won't be going over that too much right now. Oh, where are we here? So we break our vector level, have that manipulation. So our setup is our. Do you want to guess what's our setup? Is it 1, 2, or 3?
Our setup.
Yeah.
Okay, let's see. Where are we again? Let me see. Where are we again?
Yeah, sure.
Okay. All right, cool. Let me see the setups now.
So this is setup 1. This is setup 2. And setup 3.
I'm looking for, so we're looking for buys, right?
Well, we're looking for sells because we want to trade with our manipulation. Now we can look for buys later, but the idea is that we look for sells until we reach our next reversal level. Okay.
Okay, so we could do the Asia's whipsaw.
Yeah. So did a whipsaw? Well, we didn't. What's a good point? Well, we didn't take out the high, so we didn't actually whipsaw it.
Okay.
But we took out the low, but we didn't take out the high, so it wouldn't be a whipsaw.
You break and retest?
Yeah, break and retest. You're right, because if we look up here, it's impulsive Asia. So we mitigate the high volume orders and create an order block with inducement. Well, here we had high volume orders where we broke structure in the market, moved down, took out inducement, then grabbed that here. And then what did we do? Well, let's zoom in. We created a new order block with inducement here. Okay. So perfect little setup here where we have our manipulation, mitigate our manipulation here. This sweeps into that imbalance, grabs the orders, pushes down. The cause of the vector level break is this here. We have an inducement level here, an imbalance, and impulsiveness, obviously, because this is the one that created our market structure shift. I'll just write that this is a market structure shift. So
how do you identify a market structure shift? You see those little I think you should make some videos on those concepts that you use so that we could know exactly identify them and stuff like that. Because that was one of my questions I had
Yeah,
to know what is a market structure shift and what is a charge. I think you should make little videos about those concepts so that we could see them with examples and stuff, so that the rest everybody else could see what you're talking about.
100%. That's a great idea. I will do that. I have a clip from a video I had with the client, which I will cut into clips and then I'll put in where I exactly explained it. But that's a good point. Because you know, for a market structure shift to be valid, you do have to follow some rules. I will very quickly summarize it in here because I do want to go over the daily cycle. But just quickly, if we have a vector level, okay, which is here, for example, and then we tap into our order block, I'll just explain this quickly. There's two things we can do to get a reversal, which is for a market structure shift. One is we can mitigate our vector level, then create inducement for it. That's one thing. Or the next thing we can do is we can create inducement, break our vector level, and then continue down. So that's the two things we need for our market structure shift. Well, we have our market structure shift here because we instantly broke our vector level, which is here. Okay.
And the vector level, the vector is the imbalance, right? That's what you call a vector, right?
Well, yeah. So that vector level is that last available order block for price to use, in which it takes out that inducement for a zone. It's responsible for taking out that inducement for a zone. Depending on how we react to that vector level, will tell us that we'll either continue up or we'll break down. So to break down and reverse in this case, we have to we just broke our vector level instantly, so we had our market structure shift. But we can also just mitigate our vector level, right? Create inducement. It's all about inducement at the end of the day for our cells, and then this acts as a liquidity, kind of a little bit of a trendline liquidity, create inducement, and then we continue down from there. So yeah, I will do a little clips for you for sure, because the vector level is very important. But let's just continue with here. Like we said, it's a break and retest. So it's number 2, where we have an impulsive Asia that grabs these high volume orders from here. Okay. So what's our kind of next step? Well, we got to create an order block with inducement. That's exactly what we did here whilst carrying those orders. Now, if we see this as a phase 1, because it's a 5-minute order block, we could take a 1-minute trade in here. This will be our phase 2. Somewhere in here, if we're on the 1 minute, we'd probably hit that a bit nicer, but we can take our trade after our inducement sweep from here, and we can target the inducement level for this particular order block here, which is the end of that mitigation cycle. So that's how we can utilize Asia if it creates a nice order block.
Now, I was wondering, like, the difference between the phase 1 and the phase 2. I was reading the book, but I don't really get the idea.
Yeah, so a phase 1 is for a mitigation to properly occur, we need a phase 1. Now, a phase 2 is for our entry, essentially. So talking from a 5-minute or 15-minute order block perspective, this is a 5-minute. So if we have a 5-minute order block, we have a 1-minute phase 2. And all it is, in a sense, is just a final phase 2 is an inducement sweep, just like this, but on the 1 minute, okay? But what it's saying is, well, for us to have a successful mitigation to transfer those orders, we need a sweep inducement. So in this case, this would be a 1-hour order block. So this would be a phase 1 on the 1 hour. And this is a 5-minute order block. So that would be a phase 2 for this order block. But what happens is if it's still a 5-minute order block, we can see this is a phase 1 for this to be a phase 2. So it goes through the time frames until we go to the 1 minute where we can take an entry.
Okay. What time frame do you start beginning to analyze the markets from to get the top-down analysis?
Yeah, so I go daily and 4 hour. So straight away I go daily and 4 hour. If I go daily and 4 hour, say we're here for example, and none of this has happened, we're here, well, it'll tell me straight away, we've just taken inducement and we're entering a strong demand area. So my bias is going to be shifted for buyers. So it creates a mental bias on how your trades are going to be based on where we're reacting from. So I always start on the high time frame, pop into the 4 hour and connect some money. So if we are here on the 4 hour, for example, well, I'll find the breaks of structures, the mitigations of money, and I'll put that mitigation of money to here, for example. And well, what's this doing here? We're just breaking this. We're following bearish order flow. So because we're in a supply zone, well, I'm going to look for sells for today for this low because we're just following bearish order flow. And then you keep zooming in with price and start refining, finding your inducement levels for your order blocks, and then you can look for your trades. Okay.
Okay, so you start from the daily, then the 4 hour, then from there, where do you go?
Then I'll go 1 hour, and then 5 minutes or 15 minutes. Okay, and then for entries, I just go on the 1 minute, even the seconds, but only for entries really, because to trade from the 1 minute, you need a 5 minute or a 15-minute order block. That's the kind of rule of thumb. But yeah, in this case, we have impulsive Asia. Let's go to another example. And see if you can pick this example as well, okay? Okay, we got another one here, okay? So this is our Asia session, okay? So what do you think Asia did here? Did it did it add to phase 1? Did it break a retest, which is impulsive Asia, so mitigated high volume orders, created an order block, or did it Asia whipsaw?
Let's see. It looks like whipsaw to me.
Nearly, yeah, it does, but it's nearly whipsaw, but it didn't take that high. But you're on the right page because essentially we reacted very nicely from Asia, just like that. But why wasn't it a whipsaw? Because you need to take the high and the low for it to be a whipsaw. But instead, it's once again our break and retest. So it created that order block. Why? Because, well, what happened is we swept with this big movement here and we mitigated selling money. We're moving in this direction, okay? And I'll say it's our incoming direction. We're moving in a very bearish direction. So if we zoom into what price is doing, we have an inducement level. We have inducement level for here, okay? But what happens is we don't mitigate our refinements. So that's why it's important to find refinements. So this also acted as inducement level, okay? We built up price, which is something important to see. Broke our vector level here. So we had that market structure shift, okay? And then we have our final phase 2 inducement sweep. And then we can take nice trade. Protecting the highs and aiming. Well, Asia also created liquidity below. So it's a nice first target, but we can just do it to the next zone, which I don't see for a while, which is why I went so far down. But yeah, that's another one using the same concept, and we'll just do one more. We'll look for one that's not a number 2. This is a good example, but there's no clear order block here. But let's say there is a clear order block here. I know it's not clear, and we'd have to go in another time frame to find a clear order block for here. But let's pretend it is much more clear. Okay, So what do you think
Okay.
this one is for today? Is it a build-up, manipulation, continuation, where Asia adds to phase one inducement for an order block? Is it our break or retest, or where Asia creates an order block and mitigates those orders? Or is it Asia whipsaw, where we take the high and the low, create a continuation for one of them? What do you think? If you're not too sure, that's okay.
Okay, I'm not sure.
Yeah,
I'm
that's okay.
trying to get get the concepts, because you see, like, okay, I know you that you do like screenshots of the trade, but like if you do a video of how you do the top down analysis, you label and stuff like that, do videos and stuff like the trade recaps, that'll be helpful.
Yeah,
Yeah,
that's a great idea. I will look to do that. Also a factor is I haven't had a private lesson with you. I've had a private lesson with some other students, so
okay.
that is a reason as well. But yeah, that's completely fine. I agree.
I'm
I'll do
gonna
a few little clips. Yep.
I'll book a private lesson with you sometime at the end of the month.
Yeah, and we can go over this inducement kind of idea a little bit more, because the daily cycle really tackles that inducement understanding. But for this, I'll answer it for you. It's number one. So it's where we add to our phase one. So essentially, this order block needs inducement to mitigate. Well, we had the end of our mitigation cycle here. So we can see this is a large accumulation, right? Just the kind of AMD idea where we have an accumulation, a manipulation, and then an expansion or distribution if you're selling. Well, we can see this is a big accumulation. And what does that mean? Well, it means that Asia created a low, didn't mitigate our high volume of orders, right? Because we have this mitigate to here, and sweep this, okay? So it's carrying the money. We need to think, well, where are we carrying the money? Well, the money's here. We're carrying up to here. We had a nice break of structure here, and then we kept moving up from this point, but we didn't fully mitigate this area. In a perfect world, we'll go in a lower time frame and find the actual order block, but in this case, it's not it's not very clear, but it would be if we went in a lower time frame. So from this point, we mitigated inducement, and that's our mitigation inducement for our potential phase one. This mitigated to here, and essentially we find the root of our mitigation inducement. Now, the root of our mitigation inducement is here, this level here. So essentially, Asia added to our phase one of this order block here. Okay. Once we, follow our rules, go into the 1 minute, we have an internal break here, and maybe we could get a trade somewhere in here, depending on how we look in the 1 minute, and we can target these relative equal highs that were created. And yeah, that's how we utilize it for when Asia adds to the phase one of an order block. Okay, so let's go back to here. I'll also share this template, this board with you as well, so you can look back on it. Okay.
Okay.
So session time and price. So price will not make its main moves if the session time does not correspond with volatility. Okay. When we have a New York or a London session, we have much more volatility than when we don't have those sessions. So essentially, it's telling us to sit on our hands and wait for those session times to come into play for us to take the trade. There are specific times we want to use, as well as our magic minute mitigations, which are some algorithmic times in which we can use, which we'll go over. You may become inducement within inducement. And I fell for this before, and I'm sure a lot of people have fallen for it before. But when I say you may become inducement within inducement, it's saying that, well, in this case, if you're looking to trade in here, right? Yeah, we have an inducement sweep here for this, and we might take a buy here, but we're not seeing the bigger picture. And the bigger picture is that we're creating inducement for a bit of a higher time frame order block. So it ensures you sit on your hands and wait for that session time to come into play, okay, and its purpose. Now, magic mitigations, what are they? Well, they refer to high probability algorithmic trading times that mitigate continuation order blocks. We can see these best after 1.5 hours after London and New York opens, sometimes 3.5 hours after, if we don't have that opportunity to mitigate. So, well, let's just apply this straight to live charts, okay? Well, let's have a look what's happening. Here, we have a nice little order block. Okay. London here, well, for me, I'm sorry, it's not your time, but it opens at 7. But just focus on the 1.5 hours. So 7 plus 1.5 hours is 8:30. So we go to 8:30 here. So that range from 8:30 to 9 o'clock will have those magic minute mitigations. So that's from 8:30 to 9 is here, right? This time here. And did we? Yes, we did. We had a sell opportunity during that time that we mitigated our order block, and then we could have sold off from there. Okay, let's look at another one. Okay, London opened here at 7, so let's go an hour and a half later. Bang, right on the dot at 8:30, we mitigated a very nice impulsive Asia order block. That's a very good example. And then for something to mitigate, we need to find its inducement, and its inducement is very nicely there. Very nice and clean vector level here. And when we mitigate the vector level, we create internal inducement, which is here. So we could have got a very, very nice trade from there. But that's telling us that, well, 1.5 hours after London Open, we mitigate our order blocks, and it's very, very consistent. Let's have a look at one more. And we can do it for London as well, because they share the kind of same idea. Here, London opens low. 1.5 hours later, up here, we have that final mitigation, and we drop off. So it's a very good algorithmic time we can use within our daily cycle. Let's have a look at New York, okay? New York opens at 12. 1:30, we mitigate lows from here. We have a very nice demand inducement level here, very clean. Okay. 1:30, 1.5 hours after the open, I'll just say, of New York, we create that push up. We could have had a buy opportunity to the end of our mitigation cycle here. Very algorithmic, very, very precise, because, you know, the markets run on computers at the end of the day. So they have to input the times in which they want to create these moves. Let's just do one more for the sake of it. Here, 7 o'clock, we open. A little bit late, but 8:30, we mitigate up here and we create that push up. Not very clear on that one. Let's have a look for London. 12 o'clock, 1.5 hours later, we're here. We mitigate some, you know, level here, sweep that inducement, and we push up. So very, very good times to trade are those magic minute mitigations. Bit of a secret for you, but yeah. Now some extra tips. Price hunts for mitigation cycles until we hit times of volatility. Okay. So when we hit times of volatility, I should have said. But that's the important thing with phase 1 and phase 2, and you don't want to complicate it, but it's all about mitigation cycles. And objectively looking at it, we can't re-mitigate a mitigation, okay? So first step to do so is find our imbalance. Imbalance is very important. Imbalance is telling us we have inefficiency in the market, so IPA, inefficient price action. Let me just mark this out. So we have imbalance here, and then what do we have? We have wicks that start mitigating. This created another imbalance here, but it ended up mitigating to here. So we have more mitigation inducement. And the idea is that we want to grab the leg that created the start of that mitigation inducement. We have a very, very nice order block here.
How do you know that caused the inducement?
What's that, sorry?
How did you know the leg that caused the inducement?
Why did I pick here as the inducement?
how did you know that leg caused the inducement?
How did this leg cause the inducement? Is that what you're asking?
Yeah, how did you know that
Okay.
that leg correct leg that caused the
Well,
inducement?
for an order block to be valid, like we went through, it has to have, inducement, impulsiveness, and imbalance. Okay. Well, we want to mark out our possible order blocks essentially as the first thing. Well, in this case, this is a very, very clean order block because if we zoom in on it, we have a low, a manipulative low where we take out, we mitigate the manipulation because this wick was a big manipulation. We mitigate it and we push up, but we create imbalance. And imbalance is a really, very, very important factor here because it's telling us that, well, think of it like we had a lot of orders at this point to create this push, but we detached from the orders because we didn't wick into it and mitigate those orders. See how there's no wick into this order block? So what we do, we grab the start of that miss, which is just the end of the imbalance. Grab that. And essentially we're telling us that everything above this is a no trade zone for buyers because we want to sit on our hands and wait until we enter this point here. Okay. So this is our phase one inducement, potential phase one inducement until we have our market structure shift. And here we just break our vector level and have our market structure shift. But
Okay. How do you tell the difference between a market structure shift and a fake break of structure?
so a fake breaker structure, I don't really see it as a fake breaker structure because I see it as inducement pullback. But this is something we'll have to go over in another lesson because it'll take too long to go over. But essentially, all highs and lows are levels of inducement, and depending on how we react after the sweep of those levels of inducement, well, here especially, we can take reversals or continuations. But yeah, we'll definitely go over that in a private lesson together. Okay.
Okay. And how did you know? How did you know that was a market structure shift and not a church?
Well, they are independent in the way that they have different functions, but essentially, because we had an internal change of character here, it doesn't always mean that we're going to reverse from it. But here we had our vector level because this vector level was our last point, last valid order block until that sweep into this order block. Okay. And because we broke it, we had our confirmed market structure shift. We have a new demand here, and we could have traded from this demand. But because this is a 15-minute, we could have gone on to the 1 minute and looked for a 1 minute market structure shift. But like I said, it's something we'll have to go over privately because it'll just take up a little bit too much time, and it is very important. So I don't want to not put enough emphasis on it. Okay. But let's just go back to this. Essentially, the rule of thumb is if you're out of your session time, because we want to wait for the right time and price, there will be liquidity build-ups. Okay. So like here, we never want to trade here because this is just creating liquidity. Even Asia, just creating liquidity for something down here. So we want to stay out of being in the wrong session times. But when we're in time, okay, when we're following our time protocols, we create continuations and reversals. Okay. So let's look at an example of how we use time and price in the daily cycle. So here we have a nice low and we have that big push up. Well, we have a range here, but we have that imbalance. So we have that detachment from the orders here. So just think of dollar signs being injected here into the market. We grab the start of our mitigation cycle. So you can box that all up and say it's an accumulation. After an accumulation, you have to wait for the manipulation. Okay. But finding this level is the end of the mitigation cycle. So it's where we have potential pure manipulation here. But essentially, Asia, in this case, it follows this one here. No, sorry, it follows this one here, where it adds to that phase one inducement for an order block. Okay. Well, does it here?
Mhm.
Yes, it does, because it adds to the inducement level for this order block, okay? Now, Frankfurt fails to break our phase 1 level,